Welcome to the Wealth Studying Podcast. This is episode 517. Today is April 13th, 2026. I'm your host, John Pugliano. I'm also the founder and money manager at investiblewealth.com. Have a short episode for you today. Just want to reiterate the overall strength and resilience of the U.S. economy and do a little comparing and contrasting where we're at right now with how the war in Iran is impacting specifically things like the S&P 500. And if you can remember all the way back to last year, non-coincidentally, how a lot of this tracks the same way the gloom and doom was portrayed on Liberation Day with the reciprocal tariffs. So we're going into the 7th week of this war with Iran. Nothing's been resolved. The bottom line is Hormuz is still closed. It's choking off at least 20% of the world's global oil supply, which in any other time in history would see skyrocketing oil prices. And as you heard me say before, on a relative inflation-adjusted basis, based on prior geopolitical issues, things like the invasion of Ukraine or the previous Gulf Wars or even the financial crisis of 2008, on an inflation-adjusted basis, oil is still relatively inexpensive given the conflict that we're in. As I record this, oil less than $100 a barrel. Even the major markets, from the S&P 500 to the much more volatile and risky small cap stocks making up the Russell 2000, both of these major indices are either back to where they were pre-bombing of Iran or they're even higher. And again, I think this is very much like we saw with the tariff situation last year. That was steeper, had more of a V-shaped recovery, and this is still dragging on. And we're subject to major volatility swings based on whatever comment or tweet that Trump puts out. But even given all that, again, based on the fear mongering, all the war talk of escalation and World War III and global economic crisis, and really nothing is fundamentally wrong with the economy. Well, with the U.S. economy anyways. Not going so well for the BRICS nations. They rely heavily on oil from the Persian Gulf. The U.S. doesn't. Here in the U.S., yes, we've seen higher prices for gasoline, but if you're in parts of Asia right now, you're not only paying higher prices, you can't get gasoline at all. I mean, the world really hasn't seen this type of a crisis since the 1970s Arab oil embargo, and the big difference between then and now is that primarily hit the United States, and this event isn't. And for you conspiracy-minded people out there, this is almost like payback to the Chinese for their export controls on rare earth magnets. But I digress. My message is, again, simply ignore the negativity in the media. S&P 500 corporate earnings are expected to be up a very healthy at least 10%, many analysts forecasting as high as 15% or more. And unlike in the previous couple years, this is just not all the Mag 7. The other 493 stocks in the S&P 500 are forecasted to have robust growth this year of, upwards of 12%. Now listen, I can't predict the future, but I can predict that the media will blow everything out of proportion and always prey on people's fears. Just think about where we were 1 year ago besides the tariff panic. Remember DeepSeek? That was the Chinese large language model. It supposedly was better than ChatGPT and reportedly was developed for, nearly nothing and using inferior chips. There was a big fear that all the hyperscalers were overspending. There was all this circular investing. Well, yeah, how has all that worked? Again, don't listen to the media narrative. Look at the scoreboard. Over the last 12 months, NVIDIA up 70%, Google up 104%, Apple and Amazon up 30%. And that doesn't even compare to the lesser known and the ancillary companies that are up and down the AI supply chain. Companies like memory chip producers, Micron up over 500%, SanDisk, are you ready for this? Up over 2,800%. You heard me right, 2,800% in 12 months. Ciena is a telecommunications company specializing in fiber optics. They're up over 700%, and it's not all specifically AI companies. Old school heavy industrial companies are doing just fine too. Caterpillar up 170%. Cummins Diesel up 116%. The point is that if you go back over almost every historical media driven gloom and doom story that's driven the market down, they've almost every one of them inevitably been wrong. Right now, the SaaS companies, software as a service, I'd say on average they're down a good 50% or more. I bought into this dip a couple weeks ago, and you know what? So far they haven't bottomed out yet, or at least it doesn't appear to. But you know what? I just don't think these big quality names are all going to go out of business simply because of AI agents. If anything, I think the SaaS companies will do what companies almost always do, and that's adjust and adapt. Now, I'm not telling you to run out and buy this dip in general or to specifically go out and buy software as a service companies. My point is to always be skeptical of anything the media says, and especially when they're talking down the US economy over the long term.